Good morning, everyone, and welcome to the weekly fundamental podcast. I'm Rasmi Goza from Kotak Securities. Few updates on the international side. US markets are again heading for new highs as the S&P 500 gained 4.6%, Dow Jones gained 3.9%, and the Nasdaq Composite Index gained 6% last week. Emerging markets also rose smartly last week with the MSCI Emerging Market Index gaining 4.9%. The US $1.9 trillion fiscal stimulus about to get passed in the next few weeks by the Congress. As per Bloomberg Economics, the stimulus package in full would boost US GDP growth for this year from around 3.5% towards the 6 to 6.5% mark. Brent crude closed at US dollar 59.3 per barrel last week, which is marginally above the 200-day moving average. From the low of US dollar 21 per barrel in April 20, it has nearly tripled and gone back to the yearly averages. If it sustains above the 200-day moving average for a few more weeks, then it could be negative for many Asian economies including India. That was on the international side. Moving over to India, the Nifty 50 and BSE Sensex index gained nearly 9.5% last week, with Sensex breaking the 50,000 mark and Nifty 50 just closing near the 15,000 mark. Market mood has been quite exuberant in the aftermath of the union budget, along with stronger than expected earnings. Banks have further boosted risk on sentiment in the market. Last week, the Nifty Bank Index was up 16.6%, while the PSU Bank Index was up 26%, led by SBI, which alone went up by a whopping 39%. Apart from banking, there were four more sectors that gave more than 10% return last week on the back of the budget announcement. These are capital goods, industrials, metals, and realty. All are economy driven sectors. Also, FII flows turned positive last week with net buying of around Rs 16,600 crore. Indians are great in times of crisis and when we are pushed to the wall. With limited means, we had seen many new reforms coming up since the lockdown time. We went in the budget event with traditional thought process, but it turned out to be very thought-provoking, bold, and providing strong visibility of growth. It has indeed recharged everyone. On the RBI front, last week the MPC kept repo rate unchanged at 4% and retained its accommodative stance. The RBI has decided to restore CRR gradually in two phases, but emphasizes that it could open up space for liquidity injection via other tools. To improve the participation of retail investors, the RBI decided to provide retail investors online access to the GSEC market, along with the facility to open gilt securities account with the RBI. With gradual normalization of liquidity conditions, we expect short-term rates to align higher towards the repo rate. The MPC expects inflation to remain elevated at around 5% until the first half of FY22, thereby reaffirming our view that the rate cycle is over. The rate cut cycle is over. The Indian economy may be on the verge of a multi-year investment cycle similar to the 2003 to 2011 cycle, given positive drivers in both household and private sector segments. We could also be at the cusp of a big revival in the housing cycle. This could be based on the combination of factors like stable real estate prices, increased affordability, low interest rates, pent-up demand, and a desire to upgrade. The revival in housing or real estate sector could provide a bigger multiplier effect in the economy. However, the one big difference between the start of these two cycles of 2003 and 2021 is that Nifty 50 is now trading at nearly 23 times on 1 year forward PE multiple, while it traded at around 6 to 8 times before the start of 2003 to 2008 bull market, which was led by strong GDP and earnings growth. On earnings, after many years, it feels happy to see earnings revision on the upside after witnessing consistent downgrades for the past many quarters. As Q3 earnings season comes to an end next week, we can expect another 10 to 12% upward revision in Nifty 50 earnings. This will lead to some more upward revision in target of Nifty 50 also by most brokerages. The results of 37 companies of Nifty 50 that have declared Q3 numbers so far shows a strong 36% YOY earnings growth. This is way above our earnings estimates of 20% built in for Q3 before the result season. Earnings could Earnings growth could be the biggest driver of markets going forward as the re-rating game has already been played out. Between September quarter and now, we have seen FY21 Nifty 50 earnings getting revised upwards by around 14% and that of FY22 by 10%. These are based on Bloomberg consensus estimates. As per Bloomberg estimates, the March quarter going forward, the March 21 quarter earnings of Nifty 50 is expected to go up by 60%, followed by another 80% growth in June 21 and 40% growth in September 21 quarter. This will lead to back 4 quarters of amazing results and earnings growth. This should provide support to higher valuation and also provide comfort that we may not see a crash, but a normal correction in Indian markets going forward is desirable. Budget has reignited the markets after the recent pre-event correction. A combination of plentiful and cheap capital, recent labor reforms, low taxation rates, PLI schemes, and changes in custom duties may kickstart the flagging private sector investment cycle. Most of the ingredients except valuation which are required to keep equity markets going are now in place. The recent rally has been led by economy driven sectors along with banking. A combination of positive sentiment, positive FII flows, and very healthy earnings growth could keep markets at elevated levels in the near future. As we are trading in a new zone, we need to reassess our thesis and assumptions every now and then, trying to look for negative clues that can spoil the party. One can remain invested for the time being by keeping a watch on global interest rates and bond yields, as they are the biggest risk factor for global markets this year. Considering the broad based economic recovery theme and the valuation as they stand today, it will be important to identify sectors or pockets of undervaluation in context of the likely growth that could be seen in them in future. Few sectors and pockets that we can visualize which can make money for investors given their past underperformance and potential recovery are banks, capital goods, construction, engineering, oil and gas, cement, real estate, and metals. As the $1.9 trillion stimulus could turn out to be a reality in the next few weeks or by March, there could be another round of risk on rally in global markets led by the US. In this background, we expect Nifty 50 to surpass the 15,000 mark shortly and head for 15,500, led by earnings upgrades, FII flows, and positive sentiment. It is worth noting that the Bloomberg consensus target of Nifty 50 has now moved to around 16,200. So let's see and participate in this uptick till the time the party continues. So that's it from my side. Have a great week ahead. Thanks for listening to the podcast.